What's up, everyone? Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
And I'm Will.
And I'm Veronica.
Yes, we have a brand new guest on the show. Not guest, participant. You're not guesting. You're about to be here with us.
She's a mortgage hero. What are we talking about here, man?
Yeah.
She has all her challenges, everything that goes on in the female side of things, which actually puts us a lot of times at ease because I love it. Her approach is so different from mine. I'm like, Tanya, everybody like on it. And she's more like, hey, how are we going to get there? I'm like, oh my God, I need that attitude. I need that.
We need that balance.
I appreciate you.
Here.
We need that balance. So I appreciate you, Beto, coming in here and doing this with us. It's not all about a men's world. Who said that?
Exactly. And honestly, it's the women who are running it. Tanya and I both know.
There you
Beto,
go.
Thank you so much for coming on to the show. It's your first time to do a show with us, but it is something I'm really looking forward to because you're not new to all this. Even though you're new to it, you're not. You've been in business for a very long time. You have a tremendous track record of trust and authority with people. And I'm really excited for the rest of the audience to get to know more about you, what you're doing here, how you're helping, and also to participate and chime in on the parts of the conversations we normally have, but from a whole different angle.
Yeah. And there's no I and we, Goose, okay? We are so grateful to have you here together.
There we go.
All
Thank
right.
you. I look forward to contributing in any way that I can.
Yeah, you are. You will. We got you.
So today we're going to talk about DSCR loans.
Yeah.
For those of you who are brand new hearing that term for the first time, we're talking about debt service coverage ratio loans for investors. And then we're talking about refinances kind of at large. So
Yeah.
I want to take that kind of from the top. Let's do the DSCR topic first. Look, this is something that was not known or around very much until recently. If you have heard the term, you are probably getting more familiar with it, or you're looking at it for a specific reason for your own interest as an investor. If you don't know what we're talking about, listen up. You're about to learn something.
That's it.
Yeah. I've been having a lot of these conversations with a lot of my just friends, right, who have money and whatever, or they have properties that they own.
Yeah.
And I don't think anybody knows what a DSCR loan is. You want to give a basic?
Yeah, here's the thing with that, and I have to agree with you. Not until 2023 that we started making the transition into these investment loans like fix and flip, fix and hold, and then this whole DSCR came in place, and we're like, huh? But DSCR has actually been a while. It's been around for a while. It's just becoming a lot more. How can I say? People are paying more attention to it because it's like that's a new way of doing business, right? It's like FHA. Probably people didn't hear about that until like later down the years. And so DSCR is a great investment tool for investors, especially people like us, right? You own your properties and you have investments, and whose name are they under?
Yeah. You don't want it under yours
Right.
if you don't have to.
Exactly. So it's under our name. And then when we go apply for a mortgage, now we have to do a step up in basis, and we're going from our primary because we're outgrowing that. So we go out there and rerun our credit so we can buy into this other home, and guess what shows up?
Yeah.
All our investment properties. So we're like, wait, there's a better way to hold your properties and mortgages and not show up in your personal name, right?
That's pretty awesome. That's pretty awesome. So I think people are going to get confused, right? They hear about putting things in LLCs.
Yeah.
So one thing is the legal holding of your real estate, and then the other one is the monetary holding, right? So I think that's what makes the DSCR so beautiful. Just like you said, they're going to get a loan. They're going to put it on the property, not on themselves, not on their personal name, not in their personal. It's not going to come up in their personal debt service. And we've got a beautiful product that matches the LLC.
No, totally. It's a great. So DSCR is for debt service cover ratio. And I love how you put it. The loan is based on the actual property. The payment, the mortgage payment has to cover, the rents that are received on the home have to cover the mortgage payment. And that's the debt service ratio coverage right there of what they say. And again, the beauty of it is when we run a credit, we don't even have to do a hard pull. We do what's called a soft pull, and we don't use the lowest credit score of the person, like in the mid credit score. In this case, we use always the highest. If there's two investors, we're always going to use the highest of the two, not the lowest. When it comes to conventional, FHA, VA, we're always going to use the worst case scenario of the borrowers, because again, it's risk. It's all about lending. It's all about risk.
Is there a situation or a set of conditions where this may not be the right thing, the right financial product for somebody that's got investment in real estate? Like I'm literally, I'm not trying to play dumb. Like it sounds awesome because if the math's out, then you just do it, right?
That's it.
Okay, it equals what I need it to be. It's going to be underwritten, approved. Good, just go do it. But is there a situation or a set of circumstances where you go, you know what, this might not actually be the right thing for you to do?
Definitely.
Yeah.
If you live in it. You don't want to have a DSCR loan and have it under DSCR if it's your primary.
Yeah.
Why? Because the interest rates are going to be a little bit higher.
Yeah.
And because the loan is intended for investors.
Exactly. And there is a time, Andy, a lot of times the rents won't cover the ratio. And so there is a no ratio loan. So there is the bad thing, just like when you apply for a mortgage, right? You're applying full documentation to get the lowest rate. When you can show the investor, the lender or the underwriter that you qualify based on a certain debt to income ratio, your interest rate's always more favorable. Traditional financing, right? When you go to DSCR, because it is considered a commercial loan, therefore now the standard is different when it comes to an interest rate. Okay, so the interest rate's going to be higher. If the property service itself, let's say your rent is $5,000 and your payment's $5,000, that's at 100% ratio. That's good. You're going to have a certain rate. If you have 110 ratio, which means you're getting 5,100 versus your payment being 5,000, now you're at 110%, which is much better. So the higher your rents are and the lower the payment is, the better you're going to receive better interest rates.
Yeah.
But there is such a thing as a no ratio loan, which means I'm not ratioing it, but I have plenty of equity in there. Yeah. I have 20-25% equity into the property.
Well,
right?
and the reason I posed the question is because, look, the market is tight for a lot of people right now.
Yes.
Now, it's not tight for everybody because we're still doing loans and people are buying houses and they're buying investments and all that. And people are still renting them all. But in a tighter market like this, people can sometimes get a little bit extra creative and think, oh, well, this situation can apply to my scenario too. And it doesn't always match because it doesn't qualify or it's not the kind of product for the type of, or the right product for the right person or the right loan scenario. So, what are kind of like the ideal subset of conditions you might be looking at or factors to define if this is the right thing for somebody?
If they have a rental property I would say this is definitely a good option. And I think the key that I want to make sure that is really clear, it's because it's not going to show up in your personal debt.
Yeah. That's
the key. So that allows you to continue upgrading your home and qualifying for other financing because it's not going to show up in your personal debt.
Well, you have a client too. They bought the property, a 4-unit property in San Diego. Yeah. Right? And you can share a little bit about that. But they bought it with 20% down. The property does show up in the client's credit. Yeah. In their debt to income. They were looking to purchase a property in San Diego because the husband PCS to San Diego and their debt to income ratios were just way too high where we had to take her out. Like it wouldn't allow them to have purchased here because of that.
Yeah,
so
they're primary. So she owns apartments and has real estate investments, but they are not under an LLC and they are not DSCR loans. So all of that debt showed up and impacted the purchase of their primary home.
Exactly.
And that really, they ended up having to do the loan without her income. So only the spouse could qualify. And that impacted.
Exactly. And her rate was, I want to say 6.875.
Yeah.
Right? In regular traditional type of financing, non-owner, 20% down. Yeah. And we're currently refinancing her at the same rate, DSCR, right? Which we're saying like, hey, this investment can pay on its own.
Yeah.
This is a good thing for you. This investment's going to pay off on its own. Therefore, it qualifies for a DSCR program. Let's remove it completely off your credit and let's put it into the LLC that you currently have with your other properties.
Yeah.
Yeah.
I know sometimes people talk themselves out of things because they make assumptions about their scenario or their situation. Like, do you have like a recommended like property type? Is it have to be 4 units? Can it be as small as 2 units? What would you start telling people who maybe they're thinking about this or they've never heard about it before? Like, oh, this is a good way for me to separate this over here from my personal stuff over here, credit wise and debt load wise. What kind of like clues would you tell them to look for that this might be a good fit for?
The biggest clue would be, let's say we work with a lot of military and they're looking like, hey, I want to use my VA loan elsewhere. How can I do that? It's a departing residence, therefore it's going to become an investment, but my payment is $2,500 and I can rent this out for $3,500. That's when it's like, that's a big clue right there. Let's refinance it. Yeah, the interest rate is going to eat up because it's going to be higher. It's going to eat a little bit into the profits. But now you have freed up your VA to purchase. And that's the creativity of all of this. And that's where a good loan officer is going to pay attention to the small details. So you're PCSing. How do I get you to reinvest in yourself? Right? Because obviously they want to keep the property where they're currently residing in because the rent just makes sense. It's here in California, whatever state they're in. So how do I just now create a real estate portfolio for myself, leveraging that I can buy another property, VA with no money down by refinancing my other property into a DSCR. Yes, again, the rate's going to be higher. I'm not going to make as much split in between, but it's not under your name and you don't have to put no money down on the other home. So the math will still math.
Yeah, that's smart.
Great scenario.
Right?
Yeah, that's really
great
smart.
Example.
What are I'm sure you guys have already heard like myths or these like false beliefs that people might have about DSCR. Like what are some of the feedback you're hearing as you're talking to people about this? What are they asking you about? What do maybe they believe already that you're like, hey, that might not actually be, that's partially true, or that's not true at all? What are some of those kinds of things?
That's a good one for Roberto with your current loan right now.
What I would say is not all investments are good investments.
Yes.
I would say that.
Yes.
And that is probably what we're seeing a lot of right now. And we're seeing a lot of those challenges, like maybe investment properties are not appraising, which is key in DSCR, is your appraisal. Second key is what are you renting at? So we're finding a lot that people who have investments and are not keeping up with their rents because they have a good heart, which is amazing. But there's also a point where you can hurt yourself. And it can impact not only your current situation for a refi, but also if you want to sell.
Yeah.
That can have a huge impact in being a candidate for a DSCR because appraisal and rents matter.
Yeah, those are the biggest keys right there. That's great. And the cool thing about that is you actually have two good scenarios right now. You have one that's just like very difficult. Very difficult where the actual borrower has to come up with money out of pocket because the investment from when he purchased it didn't make sense.
Oh,
right?
Really?
It did not make sense.
So it wasn't like penciling out from the beginning, but now we're here and trying to do this.
Exactly. Market rents weren't penciling out. The value wasn't penciling out. And so a lot of times these investors go into things more emotionally and they have the money to do this. It sounds good because it's seller financed, at 15% interest rate. And then little do they realize that after they're in and now we have to do additional due diligence, the math is just not mathing. Right?
Wow.
And then we have the other person where the math is mathing and they're still like, let me think about this.
They're holding on to like school
mentality,
culture, right? Of interest rate. And I don't want to refinance because all I've ever heard is don't refinance because it's going to cost me more.
Oh, man.
And that is all. And I was one of those people. Prior to getting into this industry, I was one of those conservative thinkers, and I've completely changed my mind because real estate investments are that real estate investments, and we cannot fall in love with rate because rate doesn't say or tell us the whole story.
I like that. I cannot fall in love with rate. I like that because it's so true.
Really,
there's other things that factor in. There's
100%.
all about leverage, and a lot of people don't understand that. And so you bring in that point, the cultural baggage and the old traditional way. Yes, especially when we're hearing now an acronym, a DSCR. Well, what the hell is that? Yeah. What do you mean it's not coming on my credit? Right. I'm used to everything coming on my credit.
Look, from the outside looking in, it can appear to be one of those, hey, that sounds too good to be true, so it probably is kind of things.
Yeah.
But in this scenario, if the property is holding its weight and the rents are paying their way, if you will, and you've done a really good job, I'm going to say this to the credit of people who own investment properties and are fiscally sound. If you've been running a really solid P&L on your investment property, then this is exactly the scenario for you to use something like this.
That's it.
To increase that leverage, better your position, and then potentially use the advantage of that to free you up to do more of the same thing you've already done successfully once.
Are you also doing DSCRs, Andy?
In my mind, I'm doing them all day long. Well, no, but it is relatively new to me too. But I functionally get it, right? From a business perspective, it's like, oh, my income is this, my expenses are that. Great, we're in the green in revenue. You look at it that way, and your property is a business. and you're in profit and it's green and you have a way to reduce your expenses while keeping your total gross income high or higher, that's a good net situation to be in.
Yeah, like Veronica mentioned, it's appraisal, it's the rents received, keep up with the market. I know a lot of times we have a big car, we don't want to keep up with the market rents, but a lot of times we end up shooting ourselves on the foot. So you asked earlier, how many units we do. We could do from one condo, which that's what we're doing right now, and up to, 10 units. But the norm is 1 unit to 8 units. Mm-hmm. That's like the norm. Anytime you're going above 8 units, that's where it seems like we go with a no ratio DSCR. The terms and conditions are much different than your regular DSCR type of finance.
You're walking over one of the other things I wanted to bring up and let you guys talk about was that, again, that misconception is, it's only 1 to 4 units.
Yeah.
It's only 1 to 4 units because in the residential space, we go, residential finance is one, one duplex, triplex, quadplex. Yeah. It's only 1 to 4, but you can do up to 10 in this.
Yeah. You could do up to 10. 1 to 8 is the best. The rates are still in your favor. Rates we're still talking about between 6 and 8%. When you're talking about commercial, you're talking more than 9-10%, and it depends again on credit scores. So it has a lot to do with that. At that point, we don't really look at what the rents are anymore because it's considered a no ratio loan because the rate's so much higher. It's like we don't care if you could just support that. We're good with that.
Yeah.
So the deal.
That for someone who is maybe thinking about this and they're not really sure if it will fit their situation or even if they're comfortable doing it, what would you say to compel them to ask a next question and be a little more curious to find out about it?
Oh, I would say figure out the numbers, right? I mean, let's look at the benefits. Let's focus on the benefits, which we've talked about, but it's not going to hit your personal credit. So it's going to get removed from your personal credit. That's a big deal. It might also be good just to do a little check-in on where am I at? And I just want to say a little story right now. So my husband's a realtor, and he has a client who has a lot of properties and who has been a savvy real estate investor. However, those rents were all under market. So trying to, is this a good investment today? Not so much. Because this person is now trying to sell a lot of the properties and a buyer is having a hard time because the rents are so under market.
Got it.
There's a lot of impacts to that scenario, right? So I think even just having a check-in with, I have investment properties and it's not under a DSCR. What does it look like in a DSCR situation? And, let's check that out. I want to make another point, though. I'm talking to a lot of people who are sitting on a lot of equity in their home. A lot, right? They own 3-4 properties. They bought them in the great days of 15, 20 years ago. And they're like, what am I doing? Everything is sitting there and I'm not moving the money.
Yeah.
You talk a lot about this, Memo. It's all about let's move the money.
Yeah, I'm having a brain fog right now, but is it Ramsey?
Oh, Dave Ramsey.
Dave Ramsey. Yeah, I was going to say Gordon. He's the chef, right? But
Gordon,
I went from being a chef to being freaking somebody that's just very good. Yeah, finance guru who's just he's all about paying things off, right?
Yeah.
I am the complete opposite of that.
Yeah.
The way I look at it is equity, something that I didn't rely on that. I bought a home to live, to place my family. I bought a home to make sure that my rents didn't go up like they would before. And so I bought a home because I knew that would be a fix for 30 years, right? And that's the beauty. Something that we have here in the States is that we have a 30-year fixed loan, okay? You go to Canada, they have I think it's the highest is a 7-year fixed loan. Like they have to refinance every 7 years. Every 7 years, there's uncertainty what comes out over there, and so we have the beauty of a 30-year fix. So if I can I didn't plan the equity. If I can plan how to utilize that equity and earn more than what my current interest rate is and beat that inflation projection, I'm in a better situation. I just got to learn how to maneuver through those weeds and be uncomfortable with knowing I'm going to owe more. I'm not paying this off. I'm going to owe more. But if my residual, my monthly income is more and it's paying on its own and I'm earning more without having to work more, that's where all this equity comes into play. Especially you guys see here. I mean, I'm not trying to brag or anything, but we're building ADUs. We're creating the action behind it. It's there. We're trying to figure out how to create revenue. We got clients that created their garages into an additional revenue by building out an ADU and taking advantage of the new rule that we have in California by using that equity. They get a HELOC, they convert their home, cost them $60,000, $100,000, and now they're earning another $2,000, $2,400 in some areas for a 1-bedroom. 1 bath for a storage space that you were using for their car.
Yeah. For all the junk you don't need.
Used to be the garage.
So that's the beauty of it is, these investors or these home owners that have multiple properties, they just don't have somebody that talks to them. You spoke about the cultural situation. Yeah. They hold that like, I don't want to get in debt. And I don't blame some of them. These times it's very difficult, so.
Yeah, but when you're getting those cash flows, like my father, who was a big investor, and he's living his great retirement life on cash flow because he did all of this on his, without being advised. Like, that's amazing. I get to see it every day.
Yes.
Yeah, that's awesome.
Security.
To have that first front row seat to that whole thing. And, and I think today part of this section of DSCR is like, I want people to know that it's purposely, it has a function with purpose. This isn't just a band. I would not say it's a Band-Aid. It is definitely way more of a functional, purposeful thing for you. If for some reason you need cash and that property's got tons of equity and you can use DSCR to get cash, maybe there's something there for you. I really like your point about it not being able to be sold to the new buyer because basically what you're saying, the cap rate's too low.
Yeah.
They're out of rent. So that's got to get rectified. But that's also good for you as a property investor. Getting your rents up back to where they're supposed to be is going to work for you. It might be handcuffing you now that you can't sell to the person that you want to, but fix those rents. That's going to work in your favor too. And then make it even better for DSCR because the ratio will be nicer.
And here's the beauty of it. You know what documents that includes? Does it include pay stubs?
Nope.
Tax returns?
Nope. Very private.
Like, what does it include from an actual borrower in that standpoint? Like, really, what does it include? That a borrower has to do?
A lease, if you have one, and we can do one without leases.
Yeah.
An appraisal. Insurance, HOA information.
That was it?
Yeah. But nothing on the person.
And then
make sure your taxes are paid up.
You know what I mean? So they run a soft credit pool. What about if they own 10 properties? Do we need all mortgage statements?
No. We're just getting a loan on one property, on that one property.
So when the traditional financing, if they're looking to go with Fannie and Freddie Mac and we're doing, the 20% down, we need tax returns. We need pay stubs. We need a blood sample. Make sure that's you. Sorry. We need, if you have all the 10 properties, we need mortgage statements for all 10 properties. We need homeowners insurance for all 10 properties.
Yep.
If they have HOAs, we need insurance for all 10 properties. So it's like it's like, oh my God, it's stressful, and that's why most people don't want to go through that, right?
Yeah,
great point though. So this is also a great way to like restructure the holdings you have. So even if you don't need to make a move tomorrow or next year, let's just pretend for a second. Let's say you have 10 properties and you don't need to make a move tomorrow and you don't need to sell one tomorrow or next year. You can still restructure them in a way so that when and if you're ready to do those things, you're in a much better situation.
Absolutely. And here's a cool thing, aside from the regular traditional type of financing, is these loans do require either no prepayment penalty, which means you can choose not to do that. The interest rate's a little higher. 1 year, 2 year, 3 year, 4 year, 5 year. You can choose whatever you want. So for myself, right now I'm doing an ADU. My exit strategy is to do a cash out refinance, where I'm going to replenish my funds back from what I utilize for the construction loan. So I pay that off. I'll have an extra money to do another project. So I'm doing a cash out. I'm putting myself on a 1 year prepay. Because with the new administration, everything that's going on, it's favorable for me to put myself in a 1 year prepayment because I'm just going to refinance and I'm going to go rinse and repeat. I'm going to go try to use other people's money. Yeah. And that's what we're taught to do, and that's what I feel the rich do very well is they leverage, their credit. They leverage that they don't have debt to income ratios. They leverage that all these properties are owned by a different entity, which is an LLC. And, again, the LLC, when you have that, you could also get credit behind that. And that could actually help you, with instead of taking money out for you to actually do the actual work, like the rehab work, when people depart the property, go and take out a business loan from that. That's going to be a tax write-off for you.
Yeah.
It's just a more clever way how to utilize and how to leverage yourself.
Yeah.
Yeah. Well, I think this is a good point too, to kind of like pivot into like talking about refinance in general. Rates have obviously, at this point, most people know, hey, there's $200 billion coming from Fannie and Freddie. They've already started buying mortgage-backed securities. Rates are doing what the rates are doing, but I also see like the cost of getting rates has definitely started changing in the background. I want to talk about refinancing kind of in general a little bit today, and then also some of the examples and maybe some of the live scenarios you're encountering right now that someone else might go, oh, that sounds like my situation or my need or my exact conditions, and I could be looking at a reduced rate here in the next couple of weeks or months. So how about that?
Okay. I'll start.
Go for it.
So we have, what I'm finding is a lot of people who are in love with their rate, going back to that, right? But they might have a second. So they have a fabulous 2% rate, something, one of those that happened a long time ago, but they have a second with maybe an 8% or an 8.5%. And they don't realize that they need to blend their rates, and that's their true rate.
Correct.
They don't see it, right?
Yeah.
So those are opportunities for people. If you have a first and a second, and your second, that might be an opportunity to talk to us to evaluate, what's the real interest rate here.
Yeah, I mean, again, I love that we're using these scenarios because these are true scenarios. This is something that you're actually going through right now.
Yeah.
You have a client where you're representing them. They have a balance of like 400 and change at a 3.25, 3.5, something like that interest rate, right?
Yeah, right around there.
But then they have a 9 a credit for 400 and some thousand, surpassing what they owe on the first, and that rate was like at 8 and change.
Yeah.
Right?
Exactly. Yeah, I mean, it's a HELOC. It's a HELoan.
Yeah.
HELoans are around 8%.
And how that came about, the client came about, well, you can tell us. This is your client. You tell us better.
Well, I mean, I think the moral of the story was you've got these, beautiful rate. One is a beautiful rate. The other one is a normal HELoan rate. And the opportunity here is to become an investor. So this client in particular, wants to do a ADU build out in their garage, and they need cash, right?
Yeah.
Sitting on tons of equity. So what do? Is we look at both of their loans. We do a full refi, bring it down significantly. So now they're going to get cash out to build their home, and they're actually build their ADU in their house, and they're actually going to save probably about $1,500 a month.
What?
Doing this full
$1,500?
Yeah, because we're refinancing the first and the second, consolidating everything, just doing one loan.
Numbers create
It's a
$1,500.
crazy number. Yes,
That's
and do the build out.
That's a massive swing every month, but like in a year, that's $18,000 a year.
Yeah.
Absolutely.
Holy
And
crap.
we have other different scenarios that work the same way, Andy, that we're just always looking at them. Yeah, your rate's at a 3 and change. You're going to go to like a 5.5. Right now, rates are like 5.6 on the govies, 6.25-ish, on conventional. But with a lot of clients, and this is consumer debt, we already saw our debt. What is it, 38 trillion?
Yeah, you're talking about the consumer
debt?
credit card debt. It's
It's
like
like
1.3, 4.
Oh,
trillion?
1.3. I'm sorry, 1.3. That's our, yeah.
You're talking about credit card balances, right?
It's 1.3 trillion. It's the highest ever. It's the highest ever.
Which we said last month, and the month before that, and the month before that.
Exactly. And we're going to continue to say that because of the situation with our inflation, et cetera. So this is just a crisis that we're all facing. It's not just one person and everything's going well for me. No, when I go to the gas station, I pay the same thing as you, probably more than other states. When I go the groceries, like I said, I bought $100 worth of stuff and I only fill with a baby sits.
Yeah.
That was it. I'm like, that's $100 now?
Right?
Like, what is this?
No, now it's like whatever fits in my hands, and I'm like,
you know what I mean? And I was like doing one of those double checks, like if I left anything else right there, like, bro, did you not put a bag somewhere over here? But anyways, those are the true facts. That's what's happening. And a lot of people who take these lines of credit last year, they're raising their hand again. I need to increase that line of credit. And because the values have been keeping up, it's like, it's just better for us to remove you from that 3, that 2.75, and put you down to that 5, because the payment's going to save you more.
I think something that I want to maybe encourage people who haven't made this like thought yet is, instead of just like jumping on board with the whole prices have frozen or prices are declining, find out if that's true for your house, or your neighborhood, and your zip code. Don't just look at the headline, even if it's a topic we previously covered. that may not be true in the city you're watching this from. I don't care if you're in Austin, you're in Tallahassee, or you're in Chula Vista and Bonita. Find out what's going on in your neighborhood first, because what you just said is really important.
Yeah.
Again, back to even earlier when I was like, some people might self-select or opt out because they just make these assumptions about the scenario.
That's it.
Oh, well, it's not going to qualify, or it's not going to help me because of these things I think are true.
Yeah.
But
Yeah.
maybe you guys know something totally different, or maybe it lines up on paper that actually does work out, and you could be saving $1,500 a month.
I
That's,
know.
Hey, I think everyone at this table would really enjoy an extra 1,500 bills a month.
And honestly, I think there's so many people who are in that category. They are house rich and they're trying to do things. They're a little strapped right now, not because maybe business is great, but they need cash. They need access to their cash, and they're sitting on it, and they're paying 25% interest rate, right, on credit cards, when we can provide some better solutions.
Yeah, well, exactly. And the great thing about it is, again, Andy, you bring up a great point. Every state, every county is going to be different. We're in 47 states. We can assist with that. We have access to all of that stuff. So we don't just represent here in San Diego. We have plenty of people in Texas and Florida that we've been able to assist with that situation,
Yeah.
And so, yeah, the best thing that I always suggest, the best advice I can give to anyone is prepare yourself. Just prepare yourself. You're either going to hear it, you're either going to hear what you don't want to hear, or you may just absolutely hear what you want to hear. Like, the DSCR for the 4 units, it's like the client still didn't want to hear that, but it's a great solution.
Yeah.
Like, I'm sorry, we're still saving $700+ a month.
Yeah.
A month.
Wow.
By doing this DSCR. And then we strategically plan everything because it works similar to a residential mortgage. Well, you're going to not make those 2 monthly mortgage payments.
Oh, because the closing date,
Exactly.
prepaid interest, and
Exactly.
exactly. Yeah.
And then you get your reimbursement for your current escrow account. It's like,
Yeah.
you pay, the refi costs nothing.
Yeah.
Like,
Yeah,
and
Win-win-win.
that cost will be.
it's a win-win. It's like a no-brainer. But sometimes
Yeah.
it's too good. It sounds too good to be true that we just put
We get in our way. We get in our own way.
right.
Yeah. Because we've got to have something up our sleeve. Something's tricky.
Yeah. No, I get that. But again, even if people feel that way, like still take a look. Like even if like that's you right now and you're listening to like this moment or this short clip, whatever, like if you feel like, oh, there's something up there that's leave it, just go check it out. Just check it out for yourself. Because if there's something that's not a good deal for you, don't take it. If there's something that's a good deal for you, you better run in the front door with your paperwork and get ready to do it.
And what is under our sleeves? Nothing but savings.
Answers? I was gonna say
There you
answers.
go. There you
I
go.
was saying
Nothing but savings.
muscles. You guys
I
talk about
wish.
working out, and I haven't done any yet in the new year, so maybe not muscles. I don't know.
No, I wish.
When you say it, Memo, the maths.
Yeah.
There is no, the math will math. It's going to pencil out. It's very black and
If
white.
it does, it's good.
Yeah.
Earlier you asked Andy, when should people consider this? You're going to feel it. When you start seeing all this paperwork and you're going to feel it if the deal's not going to make sense.
Yeah.
It's just your subconscious talks to you. And sometimes we have the tendency of trying to ignore it, but you're doing the math, you're doing the paperwork. It's just like you're doing one of these head scratches like this I just don't know how to put this together.
Yeah.
And then you get the other refinance and the quadplex and it's like, wait a minute, I'm scratching my head because it's too easy. Like, it's just too easy. It's like,
Right.
I don't even have to ask so many questions. The market rents are this, the payments. Like, wait a minute. What am I missing here?
Yeah.
Am I confusing myself? Does this really even matter? And one of my things is always, you're going to trust, but
Verify.
that's it.
Yeah.
That's it, and that's the key to this is just, it feels too easy. And when it feels too easy, it's because you have a great deal. Everything pencils out. It's a deal. Gotta move forward.
Yeah.
And let's talk about the why, because the interest rate is not that different. Maybe a point different from a primary
Yeah.
purchase. It's like maybe a point. And the reason is because the risk is less, because the loan is on the property. So the lender feels more comfortable. This is a good real estate deal,
Yeah.
right? As opposed to being a primary property where,
Yeah.
yeah.
I like that. Yeah. You already have 20%, 25%, because some of them go to a loan to value of 75, 80%, et cetera, et cetera. So there's just more skin in the game. And so, yeah, the investor sees it like, this is not a loss. Market rents, they're no dummies. We already have data. Data is everything.
Yeah.
If we pay attention to the data in certain areas where the rents are, you see that they've been going up. The trend has been going up. Like, okay,
Yes.
bye. I'm hoping he doesn't make the payment.
Well, I have, I'm always yelling in the corner. I'm like hammering, these points home to people. But Vero, I want to ask you to delicately, in a very much more polite way, tell everyone what they should be actually considering right now. If anything we talked about today that sounds like the situation. And also, let's talk to the person who may be feeling a little bit like embarrassed or ashamed about their personal financial situation. Like, hey, I made some bad debt choices, or I made a decision. It didn't turn out the way I thought. Now I'm holding this debt, or I have this loan that's $400,000, or for whatever the reason is. I have my own way of delivering this news. What would you tell somebody who might be hesitant to step forward and say, I need help? What would you tell them?
Let's go with two different scenarios. One is the person who's out there who has a lot of equity in their home, but maybe they have debt, right? So they're house rich, cash poor. They're paying 25% interest rate. They're married to their interest rate, but they're hurting, because they transition careers. Maybe they lost their job. Maybe they've got school tuitions and commitments that they've made. So considering a refinance right now is probably something to consider, right? To help alleviate some of that, help deal with what's happening right now with inflation. So to give you some breathing room, I think that's really key. I had another scenario, but
yeah,
I'll pass
Go
it on
for
to
it.
Matt.
No, yeah, that's it.
Let me
It's
think
okay.
about
When
it.
you remember it, we're going to come back. She has a much better way of delivering the message. I'm like, get on it. Get your paperwork together.
No, exactly. Don't be ashamed of the situation. We all go through it. We all have those freaking little devils. It's like they say, I love the cartoons where they have the angel and the little devil. And, usually the devil's the side that we always have the tendency to listen to just because it sounds funner. And over here it just sounds a little more proper, a little more organized, et cetera. So it's like, I'm not used to that, right? But the best thing to do is just prepare yourself, Don't pay attention to either one of those. Just go out there and just use your subconscious, because it talks to you. Pay attention to that and just prepare yourself with the documentation and just see what my options are. There's nothing that's going to tie anybody, force you to do anything you don't want to do.
Yeah.
It's just
good to know.
Knowledge is power, like they say, when applied. Right? When applied. If you have all this information, just go out there and let's just see what you're able and capable of doing. Everybody has their favorite lender. Go to that favorite lender.
Yeah.
Let them guide you through the process. It is what it is.
I remembered. So This is like those, this is what we've been talking about all the time, is if you bought your house in the last 3 years, you are a refinance candidate. I mean, it's a no-brainer. You will probably save a point or more. So come talk to us, because those, if you bought a house here, you probably bought at an 8 and a 9% interest rate. So we're going to be able to help you out.
And what I would like to share on what she says is, one of the things is we know that the trajectory is that rates will start going down, and we're fighting. We're getting the printing money machine just came on. I call it the counterfeit money, right? Because it's just money that's going to be printed out. It started December 12th. So it's like, and then in addition to that, our president asked Fannie and Freddie Mac, like, hey, you guys service all our loans, you got all you start helping us. So if the Fed's not going to help us, you're going to help us. So we're already going to see that trend. So if you're a candidate right now, in a year's time, we can refinance again. Don't pay points. Like 1%, if somebody's doing a refinance and you're doing a loan for, let's say, $600,000, and you're paying points, because I hear a lot of clients say they're offering me 4.some%. Well, you got to look at the fine print, right? Yeah, of course, I could do the same thing. Yeah. It's going to cost you an arm, part of your leg, and maybe we'll have to dip into the other arm, right? Yeah. So it's like, the way I like to do these things is like, don't throw your money away. It usually takes 7 to 10 years to recuperate 1 point. That's 1%. And people think if my rate's 6%, I'm going to go to 5% because I'm going to buy 1 point. That is so not true. You're only going to buy 0.25%, which in difference in payment on a $600,000 loan is going to be probably, I'm going to say, between $60 and $90 a month.
Yeah, it's very minimal.
If you do the math, it's like, why do that? If in next year, if the rates go down from 6 to 5, right, and they're going to go down the low 4s, I'll take the risk and not pay anything, save my money.
Yeah.
$6,000 a lot. Yeah. That's somebody's, a semester of college tuition for some people, right? Yeah. That was for me. I just paid a college tuition. So.
Yeah.
So I know that it was under that, which is great. So thank you, San Diego State, by the way.
Yeah.
But
well, as we wrap up today, I want to talk to all of you who might be hesitant about saying that you need help. Look, speaking for myself, I know I cannot be the only person that you know who has maybe made a decision you thought was going to go in your favor that didn't go in your favor. And you had to like rectify it somehow and use what you had and the tools that are available to you to get out of that situation. Not just grit, working harder, pinching pennies and all that. Those things can work for you. But in the situation where maybe you have a home and you have a lot of equity, let the house be a relief valve for you if you need it. Please have no shame and don't hesitate to ask the questions to at least know where you're at and if there's a solution for you. Please don't just opt yourself out. Oh, I can't because, or my house won't because, or da-da-da. If you don't actually know, you don't know. Come ask Beto, come ask Will. Talk to somebody here on the team that can actually help you and then give you a game plan if that's true. If that is true that you can't, fine. Then when can you? When can you get relief? What's an alternative method to get you back in financial shape that you want to be in so that the home isn't a burden? We want it to be a place where you live, that you enjoy, you create memories in, and it creates a lifestyle that will serve you well, rather than be something that you are just striving for constantly and cannot enjoy. That's my last thought for the day.
No, that's awesome. And I'm glad that you bring that up. A lot of times, I have to say it to myself, it's just money. It's just money. You know what I mean? It's just money. There's plenty of people who have all tons of money, and they just regret they didn't do certain things because their health wasn't as important at that point in time because they went for the grind and all that stuff, missing the point that there's better things to do, and there's a better lifestyle to live. So it's just money is what it is. And if you have it wherever, then it is what it is. I'm not just saying you've got to go out there, spend it, but you know how it is.
There you go. It's
Beto,
an
how about you?
instrument. For me, I want to focus on all of you who are sitting on a lot of equity in your home and you've been itching to do something. This is a good time for you to explore that. Take a look at that equity, see what you can build that ADU in your garage, tap into it. This is the time. This is the time we've all been waiting for. I think we've hit it.
That's it. Especially knowing that there's such a shortage supply of homes.
Yeah.
It's like the data is there, the information is there. It's already given to us.
Yeah.
What do we do with that?
Yeah. Last week when Brian and I were talking, I said, listen, you heard us say it on the show a number of times. We don't have a crystal ball. We don't know when these times are going to happen. We don't know what window's going to open where there's going to be an opportunity. And then last week, literally, I was like, hey guys, remember how we used to tell all the time we don't have a crystal ball and that someday will happen? Like someday's happening.
It's happening.
And we don't know how far down the road these kinds of things are going to come upon us, but we're here now. This is the window where if you have hesitated to get a purchase loan accepted, like go for it. If you have been on the fence, get off the fence. If you've been holding off on trying to refinance or ask a question because you're ashamed, go do it. At least start right now and make 2026 the year that homeownership changes for you and for your family. And I'm really excited about this season of the show as well. We have new face today, new faces coming, and I'm really excited about what our outreach to the community online is going to be this year. So Beto, thank you so much for doing your inaugural show with us. You did it.
Yeah, boom, boom.
Y sí hablamos español. Entonces, para nuestra gente latina, estamos aquí para apoyarlos con refinanciamientos, con los préstamos que ocupan, para apoyarlos como sea necesario.
There you go.
Tune in next week where Beto does the show all by herself.
Yeah.
You did great today. Thank you so much for
very
being on the
good.
show.
Thank you so much,
Memo,
yes.
You did awesome too.
Yeah, I
Your first show
appreciate
back
it.
this year.
It is.
I'm excited for this new season of Mortgage Heroes. Thank you guys so much for being on the show this week. Thank you all for watching. Remember to like this video, forward it to a friend. Look, you might have someone in your life that you might know their situation needs some help and they could benefit from some expertise and some professional guidance. So make sure you send this to them, share it with them in the most polite and delicate way possible. Beto, thank you for saying it in a polite and delicate way so it's easy to share. Make sure you subscribe to the channel, and we will look forward to seeing you all again next week. Later.
See ya.
So if you enjoyed this video and got value from it, subscribe right here. And if you want to watch another video, click right here.